Prediction markets are rigged. You're betting against insiders. Don't touch them. If you spent any time online lately, you've seen that narrative everywhere. And I get it. On the surface, it can look sketchy. New platforms, new types of markets, headlines about information moving prices. So today, I want to slow this conversation down a bit. I'm going to walk you through how I actually approach prediction markets as a professional bettor, when I'll trade them, when I won't, and how you can think about them intelligently instead of emotionally. For those of you who are new here, I'm Rob Pizzola. I'm a professional sports bettor, and this is Circles Off.
Here we go.
This episode is presented by Kalshi, and before we go any further, let me just address the obvious. Yes, we monetize Circles Off through partnerships with operators. That's how this business works. We've partnered with sportsbooks, exchanges, and now a prediction market. And I know how that looks. But this is not going to be an infomercial. I'm not here to tell you that every market is safe. I'm not here to tell you to blindly trade anything. What I do believe is this. Prediction markets are not going away. If anything, right now they're growing. The space is evolving very quickly. And as bettors, you can either ignore that or you can learn how to navigate it intelligently. So this video isn't about hype. It's about understanding what game you're playing before you put your money into it. Because when it comes to prediction markets, the real question isn't, are they rigged? The real question is, do you understand the structure of the market that you're entering? Let's break that down. Before we even talk about prediction markets, let's start with something uncomfortable. The playing field in betting has never been perfectly level. Anywhere. Not at traditional sportsbooks, not in exchanges, not in DFS back in the day. Nowhere. Now, to be clear, I'm not one of those people who thinks that sports are scripted or rigged. In general, professional sports are legitimate competitions. Outcomes, in my opinion, are not secretly predetermined. But information asymmetry, that absolutely exists. Injuries leak before they're officially announced. Lineup changes, they get whispered around. Beat reporters tweet something subtle, and the market moves before most people even see it. Sometimes the market just reacts faster than the public can. And sometimes the edge isn't even about an injury. Years ago, when the Vegas Golden Knights entered the NHL, they were phenomenal at home early in their inaugural season. And I had friends who worked in the nightlife industry in Vegas. Every now and then I'd get a text, said, hey, a bunch of players from so-and-so team, the visiting team, are out at a club right now. It's 3:30 in the morning. Now, is that guaranteed to matter? No. But is that information that not everyone else betting into the same market had? Yes, it is. And that's the reality of betting. Sometimes you react faster to public information. Sometimes you're closer to a source. Sometimes you just notice something others don't. The point is not that sportsbooks are corrupt. The point is that the playing field, it's never perfectly flat. None of that is unique to prediction markets. Information, speed, access, awareness, that has always been part of this game. So when people say, don't touch these prediction markets, insiders will crush you, my response is very simple. That dynamic already exists everywhere else. So what actually is a prediction market? Let's strip this down to the basics. In a traditional sportsbook, the structure is very simple. The house sets a price, you bet into it, the house takes the other side of your wager. Yes, the book might try to balance action, they manage risk, but at the end of the day, you're betting into the sportsbook. They are the counterparty. Now you compare that to a prediction market, instead of betting against a house, you're trading contracts. A contract represents an outcome, something that either happens or doesn't happen. The price of that contract reflects the market's implied probability. So something is trading at 60 cents, as an example, the market is saying there's roughly a 60% chance that it occurs. But here's the key difference. You're not betting against a centralized bookmaker. You're trading against other participants, other traders, other bettors, other people expressing their probability through price. The platform facilitates the market, but the price is largely determined by supply and demand. And on the surface, that sounds cleaner, more efficient, or more pure. But here's where things get interesting. Let's talk specifically about sports markets on prediction platforms. Let's say there's a college basketball game. I don't know, Iowa versus Wisconsin. If you're trading that game on a prediction market, instead of betting it at a traditional sports book, what has actually changed? The answer? Not much. The underlying risk is the same. The ball still gets tipped, the game still plays out, injuries still matter, matchups still matter. The outcome is still determined on the court. You're still trying to assign a probability to an event that hasn't happened yet. That part has not changed. Take the NFL draft as another example. Draft markets move aggressively on information. They always have. A player might open up at plus money to go third overall. Then a report comes out, and then a mock draft, and then another report, and then sharp money hits the market. And by draft night, that same player that was an underdog might be sitting at minus 10,000. Does that mean that the market is corrupt? No, it doesn't. It means information entered the market. And that already happens at traditional sportsbooks. Lines move on injury leaks. They move sometimes on insider reporting. They move on whispers. They move on sharp action. Information-driven movement is not new. So when you're trading a sports market on a prediction platform, you're not suddenly entering some brand new dangerous ecosystem. You're still operating in a world where price reacts to information. That's always been the game. Now, this is where we get into the nuanced part of things, because there are markets where information risk is very real. Let's use a reality TV example. I won't spoil anything here for anyone, but there's a market up right now on who will win an upcoming season of Survivor, season 50. Now, from what I understand, this season will have a live finale. So technically, the winner isn't publicly known yet. But here's the important detail. The season itself has already been filmed. The final 3 contestants are already known. All the votes have already been cast, which means somewhere a group of people already know who they voted for. That information exists. There's roughly $3 million in volume traded on this market right now. And one contestant has been sitting around 75% probability, and that price moved almost immediately after the market opened. Now again, I'm not accusing anyone of anything, but this is where you have to pause and you have to slow down. Because before I trade anything, I ask myself one question, one very specific question. Is this a probability market or is this an information market? If I'm betting a basketball game, that's a probability market. The outcome hasn't happened yet. We're all forecasting. But if I'm trading something where key information is already determined somewhere behind the scenes, even if it hasn't been revealed publicly, that changes the dynamic. If votes have already been cast, if finalists are already locked in, if the chart shows a massive spike the moment the market opens, that signals danger to me. If you see millions in volume and one side is heavily skewed almost instantly, that's danger. Because at that point, you might not be forecasting better than the crowd. You might be stepping into a room where some people already know how the story ends. But here's the important distinction. That's not prediction markets are bad. That's don't walk into an information war unarmed. You don't have to trade every market that exists. Part of being a smart bettor is recognizing when the game you think you're playing isn't actually the game that's being played. Now let's contrast that with something completely different. Take a market like what will be the highest temperature in New York City today, available on Kalshi right now, or Miami, or Los Angeles. Climate-related metrics. Even a market like annual measles cases. These are very different animals. Some markets are just forecasting exercises. There's no secret room where somebody already knows the answer. There's no group of insiders who cast votes weeks ago. There's no executive memo sitting in someone's inbox. It's just probability. Weather models, epidemiology projections, trend analysis, public data. Now, sure, someone might have a better model than you. Someone might be faster. Someone might be smarter. But that's skill asymmetry, not information asymmetry. There's also typically very little incentive to manipulate something like that. The volume on these markets aren't massive. The real world outcome is hard, if not impossible, to influence. You're not changing the temperature in New York to win a contract. You're not meaningfully moving nationwide measles numbers because you want to profit $400,000 on a market. So those markets are fundamentally different from something like a pre-recorded TV outcome. Now let's use a corporate example. You might see a market like, will Tesla release a new model this year? When that market first opens, it may look completely normal. Balanced trading, gradual price movement, just people forecasting based on public information. Then one day, you see a sharp spike. Big volume hits. The price jumps aggressively in one direction. That's your signal. That's when you pause. Because maybe news is about to break. Maybe something internally, maybe someone internally already knows something. Maybe the market just shifted from probabilistic to informational. And this is the key lesson. Every market has some sort of life cycle. Some start tradable and they end compromised. Early in the life cycle, it might be a forecasting exercise. Later in the life cycle, it might become an information battle. Your job isn't to trade everything. Your job is to recognize which stage you're in. There's another concept that matters here as well, the counterparty. Let's go back to a sports example for a second. When I was betting NHL at a high level, there were days where I'd identify a number that I loved. Big edge. I'd hit it hard. The line would move immediately in my direction. I had market impact. Great. But then later in the day, boom, it gets smashed right back the other way, right in my face. Big money, aggressive movement into bigger limits, all the way back to my original number. And at that point, I'm not emotional. I'm not defensive. I'm just asking myself a couple of questions. Who is on the other side? And what do they know? Because if someone is willing to move serious money into the market against me, I have to respect that. Maybe they know about a flu bug in the locker room, maybe a goalie injury or lineup change that hasn't been reported. Maybe they just disagree with my number. But that internal dialogue is part of being a professional bettor. And that question, who is my counterparty and what do they know, exists everywhere in betting. Sportsbooks, exchanges, DFS, prediction markets. This is not some unique danger that only exists on new platforms. It's the same fundamental dynamic. You are always trading against someone. The only question is whether you're aware of that and whether you're prepared for it. So the real question becomes, should you bet prediction markets? My answer is not yes to everything, and it's definitely not stay away from all of this stuff. It's this. Don't blindly trade everything. Evaluate the structure, look at the volume, look at the price history, look at how the market behaved when it first opened. Did it move gradually over time as information became public, or did it spike aggressively in the early going? Ask yourself, is this still a probabilistic market, or has it turned into an information market? If it's a basketball game, a weather forecast, a macroeconomic metric, you're probably just forecasting. If it's a pre-recorded event, a closed-door vote, a corporate announcement that insiders might already know about, you need to tread carefully. This isn't complicated. You don't need some advanced degree in market structure. You just need to slow down and you need to observe. Because 99% of the time, you can tell whether you're walking into a forecasting exercise or an information battle. And if you feel like it's the latter, in my opinion, move on. There's always another market. The edge in betting isn't just about picking winners. It's about choosing the right games to play in the first place. Now, as I mentioned at the top, this episode is presented by Kalshi. And again, I want to be transparent about that. We monetize circles off through partnerships with operators. That's how this channel exists. That's how we fund the content and the production. But sponsorship doesn't mean blind endorsement. If you're going to explore prediction markets, whether it's on Kalshi or anywhere else, do it intelligently. Don't trade something just because it exists. Look at the order book. Look at the chart. Look at how the market behaved when it opened. Think about the structure. Be smart about it. Ask yourself whether you're forecasting or whether you're stepping into an information battle. There are markets on there that are thoughtful. They're interesting forecasting exercises. There are others you might decide to pass on. That's all part of being a disciplined bettor. If you want to check out the types of markets I've been referencing, you can use the link in the description below. Just make sure you approach it the same way you should approach anything else in this space, with skepticism, with structure, and most importantly, with discipline. I'm genuinely curious what you guys think about this. Drop a comment below. What types of prediction markets would you never touch? And on the flip side, what markets do you think are completely fair for forecasting exercises? Let's actually have a thoughtful discussion about it instead of just yelling, rigged at everything that's new. If you enjoyed this breakdown, and if you want more of this content, deeper dives into stuff like market structure, edge, information risk, all of that, make sure you hit like, make sure you subscribe to the channel. There's a lot more coming on this channel. I might even do a future episode where I pull up a few specific live markets, walk through some of this stuff in real time, how I analyze them, what I'm looking at, what I'm avoiding, and why I'm avoiding it if I am. Appreciate you watching, and as always, think before you bet.